Ladies and gentlemen of the crypto space, we're live on a Wednesday, August 2nd at 4:15 p.m. Better late than never. Busy day for myself, but obviously there's a whole lot of head spinning things in the market that drive people nuts, fill people with anxiety, leave people with thoughts of why they're doing what they're doing, and can you make different decisions? Should you be doing things better? Are you taking on too much risk? Are you too afraid? And I like to remind everyone that the resolution to anxiety is understanding the way the system works. The only way to navigate markets is to alleviate the anxiety engaging with markets and to measure from different time horizons and get the time horizon correct. Too short a time horizon, you're going to drive yourself nuts. You can't sit there pulling to refresh. You can't sit there control F5, Alt F5, whatever you want to do to refresh that screen day in, day out, every second of the day. This can drive you nutty. Can't do that. So let's put up a green screen because it's late in the day. I don't have my I don't have my T's crossed and my I's dotted, but we have the Bitcoin chart. Not that it's anything significant necessarily to the things that are on your mind, but general directionality is promising. The 29 region obviously has been in a relatively decent price channel. You zoom in a bit. There's obviously critical levels here, and you got some great MAs, a great TWAP down here, which is basically riding weekly TWAP. It's nice when you see these clear hits on TWAPs. It's like a clear hit. It's like boom, because that is obviously actors following these price points, and you have a congestion of interest at these particular pricing zones, especially in a downward leg. Obviously, support is a position of weakness, but structurally, you could have positions of strength at a larger time horizon with like this leg down. That's a weak position, but overall, this has overtones of larger support if you zoom out a couple of weeks. A great example of that, zoom out, is the dollar, particularly the DXY, US dollar versus Japanese yen, and the European euro. I was speculating maybe we hold the TWAP as resistance, but this thing pierced right through the damn weekly TWAP. All right, so be it. The market, the charts tell us what it is doing. We could speculate on potential ways the market could head, but ultimately it's telling us a story. You see this chart, and it's literally telling you a story of what the hell is going on. That is a hell of a wick to the downside. That wick to the downside, if we zoom out to the 6 month, is not nearly as insane as that wick to the upside, but this is brewing one heck of a wick to the downside. That's a heck of maybe a hammer. We'll check back obviously in late December of this year from a 6 month time frame, 6 month candle perspective. If you close at this price point, this is likely indicative of potential invalidation. Obviously, if it closes below the close of the previous candle, then that's you're leaning towards more confluence to directionality, continuation to the downside. But the length of that wick is not necessarily supportive of that. So you still have a bit of indecision. You have a bit of data that's indicating, all right, is that really confluence for continuation to the downside? How the hell are you not going to have continuation to the downside off a wick like this on a 6 month chart? That is just an absolutely massive wick. We don't see many wicks like that. Obviously in '08, that's about it. 1985. That was a heck of a year. Look at those wicks to the upside, and look at that suppression in dollar demand. And you don't just have suppression of dollar demand organically. As I argue quite comfortably, the dollar is it's a game of it's a game of charade. There's a great deal of a collusion at a global sovereign level to manage the relative value of these fiat currencies. Given the global debt load, how the hell does the dollar not just go up, up, and up? And that's what's happened since 2008. That's why I like to look at the '08 perspective. '08 perspective and the zoomed out perspective means so much. You know, you can literally compress, look at this perspective. You compress how much of history into this little tiny chart. And obviously you zoom in and look at it granularly, but you know, it's so imperative to let the chart tell the story. And I just see this harmonic to the downside, which basically is an expression of global collusion efforts to maintain the status quo, the dollar regime, for as long as possible. Nobody wants to get caught holding the bag, and they obviously want to keep the regime kicking. Nobody likes the status quo changing. You get wars over natural resources as fiat currencies devalue and consumer staples and commodities increase in price, and nobody wants that. Countries don't want that, and nobody wants that either. They want calm. They want to grow and prosper, and that's just the bottom line. Tapsy's in the house. Gazika, late stream. I do my best. It's been a busy day. The Hook. Hey, Noah, late stream. What are your thoughts on Aura? New proposals out of migration of multiple chains. Price action lagging, but looks undervalued to me. Well, price action and undervalued are obviously subjective interpretations. Overall, structurally, me seeing it deploy to other chains is akin to international expansion. I would consider the Alt L1 and L2 Ethereum chains to be emerging markets. But then in the scale and scope of things, Ethereum mainnet's an emerging market. So those are just absolutely microscopic markets. Anything, Arbitrum, Optimism, even Avalanche, it's microscopic compared to mainnet, and mainnet is basically zero in the grand scheme of the global currency supply. How many dollar liabilities on mainnet? That's why we look at the stablecoin chart on DeFi Llama. Microscopic markets. But that's where you have the volatility, low liquidity, and if you have flows, just a moderate flow into a relatively low liquidity market is going to cause significant volatility to the upside with regard to flows in, flows out, obviously depreciation to the downside. Low liquidity is an increased likelihood of volatility implied, of course. So I generally have a high opinion, other than the Curve Federation, there's the Balancer Federation. Those are the only federations. I've argued recently there's proto-federations. Liquid came onto Bunny, convex layer on top of Bunny, and Hero actually has overtones of a federation, but Solana is also a microscopic network with regard to liquidity depth, and they're proto-federations. You know what it takes to find confluence and confidence that a federation is emerging is actors jumping in to support and just growth, expansion, territorial expansion. I mean, that is a sign of kind of what like BRICS is doing, but by definition, that's like a proto-federation. You have actors saying they want to participate, but there's all this counter confluence suggesting, oh yeah, that's not going to be so easy. That's going to take a lot of time. So that's what I really look for. It's kind of like organizations, trade organizations, international trade deals. When you have multiple actors coming to an agreed upon set of terms, confluence of terms, shared vested interest, that's where strength presents. And we know that everything is analogous. You have your comparisons to basic biological and physical phenomena. So there's strength in numbers. So the more organizations that are part of a federation, there's more strength. And financials being a manifestation of anything that humans can create, they're a manifestation of all these physical properties and basic biological properties we talk about. So therefore, financial systems that have this type of federated behavior are strong, or you're either growing or you're getting weaker. It's one or the other. That's the way systems work. Expansion or contraction. That's it. So generally speaking, there's complexities with regard to talking about aura, especially like portfolio composition, and you're probably in the realm of thinking about position size and how do you size that? You size things relative to risk, and risk is macroeconomic considerations. Risk is cash position size. Risk is debt servicing load, and things of that nature. And for myself, I find it comfortable to have the position size I currently have. Um, and I haven't done anything with the portfolio in quite some time with regard to increasing exposure to assets. Obviously, the cash position has just been in accumulation mode pretty much all throughout 2023 admin and good part of 2022. Do I get tempted to deploy? The optimal deployments for me right now are the micro deployments, 0.01% of the portfolio that turns into 1% of the portfolio. And those are few and far between for a person even such as what we do, digging into these things to the degree that we do. The only one I've nailed in the last 2 years is YOLO. That was a micro deployment, and it ported over to mainnet, and then it went 10, 15x on the money, 20x on the money at one point, and it's producing a fair amount of cash flow. So that's actually quite nice to see. It was a micro deployment, zero 0.5%. It's got to be a good. It's not 1%. Yeah, maybe it's 1% of the portfolio, 1.5% of the portfolio at this point. I mean, that was a relatively small, four-figure deployment. That's well over five figures at this point. So that's nice. Producing 150% at an LP level? I don't know. So sometimes you catch a nice one, but in the end, it's about expectations. Look, that doesn't change much for my portfolio. If 0.5% turns into, 1, 2, 3%. That doesn't change much. This is the margins, but the margins add up, and the margins contribute to the overall, holistic results or effects of the portfolio. And these are things that shape and mold the portfolio over a decent time horizon. You can't measure these things over weeks. You really can't even measure them over months. You got to measure these things over years. And the most important thing is over years, survivability characteristics. That's the big bet. That's where you get the big numbers, and that's where you get the comfort from. You're not worrying about shit that's going on today, and if it survives, then it becomes something big, something systemic, something with, federation attributes. And that's how you catch big fish with small bait, so to speak. Do you think the DEX landscape will eventually be dominated by one DEX only? Well, it's a race to the bottom with regard to fees. I have a high opinion that these financing regimes are critical. Incentive systems are used to guide behavior. I mean, all the big money people, Larry Fink even says we're going to have to, make decisions for people, or we have to guide behavior, and the optimal way to do that is with incentive systems. So I think they're very significant, and that comes back to like the balance of federation and the curve federation type conversations. So it's not just the DEX that matters, because along with the DEX is liquidity depth for any particular assets or liabilities for that matter. So how do you influence depth of liquidity by applying incentives, and how optimally you want to apply incentives in a capital efficient way such that you're just not getting one-to-one, maybe getting a multiple based on the net effect of what has emerged with these two particular federations, these financing regimes that offer a capital efficient way to incentivize liquidity depth. How do you create liquidity for a new protocol? You have a new business. You raised $100 million, and you're going to have an asset for some reason or another, either equity representation or whatever, what have you. you need a price. How do you get a price? You got to pair it with a dollar liability, a unit of account. And how do you get that liquidity such that you don't have ridiculous volatility? You got to get liquidity depth. And how do you do that? You got to finance it. So the financing of liquidity depth is, I think, systemically, existentially critical to the deployment process of these types of assets, which is akin to like IPOs in traditional finance. I'm sure there's a way we could draw comparison to the way the big banks and the market makers are organized and coordinated such that there's a liquidity depth when the IPO launches. So these are these types of systems, but open, public, transparent, and things that we're digesting that, you know, you wouldn't typically digest from an IPO standpoint. Who looks into the legal structure of an IPO? What, 1,000 pages worth of bullshit about what company's doing what and the relationships between banks? You're not even considering IPOs. So we get to consider these types of things from a crypto perspective. We have access to them, which is quite interesting. But you have to at least acknowledge that the things that we're interacting with, the things that we see opportunity with, are comparable to a lot of the things in traditional finance that we typically didn't have access to. So I kind of learn a lot of things about traditional finance vis-a-vis the lens of the crypto space indirectly. And I never knew these things about traditional finance, but I see them in the crypto space, and I look for the history and the precedents. I'm like, oh, it had to work that way. How the hell do you have liquidity depth when an IPO goes live? You need the market makers. Who finance the market makers? Obviously, the company going public had a deal, an arrangement, acquired the third-party actors to provide the market making. They hire them. They have a contract, and maybe it's organizations that are required to by policy of the brokerage, the exchange, Nasdaq, New York Stock Exchange, to provide market-making services upon IPO. It's probably the bank making the arrangements, the IPO bank. But point being, that's exactly what we see occur here in the crypto space. You need these ways to finance liquidity depth, and I find that quite fascinating. I'm sure you've talked about it, but can you give a 60-second breakdown of Curve and what you think is going forward? So there's a couple of different scenarios that I think are the case. I think nothing is ever as simple as it appears. It's not. I think the most absurd observation or speculation is that Mitch borrowed debt to buy property. That would be like, that's idiotic. That's like a degenerate move. It doesn't make any sense. If I so I'm a software engineer by not by education but by trade. It's my career. So if I spent and had a capacity to write software like that, I've done my fair share of Android applications, but you have a vested interest. You have a love and a passion for what you created. It's a child in many regards. It's a manifestation. So it's a big deal. You don't necessarily want to give up ownership. So he's got the vast majority of ownership, the critical ownership. So sure, you take debt. What do you do with the debt? What do you do with the free cash? Obviously you're going to want to diversify to a degree. Maybe you consume to a degree. Who wouldn't want to consume a little something? But you obviously have to keep reserves. Maybe you're investing in U.S. Short-term bills, get these relatively high risk-free rates, dollar denominated, of course. And so maybe he's been pushed to the point where he had to give up some of his vested interest, and that's why he's OTCing. But ultimately, the OTC has been quite remarkable. Everyone seems so calm, cool, and collected. The OTC buys, Frax, Yearn, even Abracadabra seems calm, cool, collected. The Aave folks are all calm, cool, collected. It's not like anyone is like, oh shit, this is bad. I mean, the only people saying this is bad are social media bugs. It's not the systems, or at least the persons that are in the war room, the developers in the community, like the real people that know him and talk to him. So I'm inclined to think one is probably extremely manageable, obviously via continued OTC, uh, and the amount of curve that he has access to from an escrow standpoint on a yearly basis, he could finance these payments in perpetuity. And what does that do? That obviously draws down the debt load in exchange for distributing the vested interest in the organization. He's distributing the governance control. So it's not necessarily something he wants to do, but maybe that is intentional. At some point, when I'm thinking about investing in an organization, if there's excessive concentration of vested interest, that's not necessarily something I want to see. What I want to see is distribution of vested interest, and that decreases the risk profile amongst many actors. Um, so that is the first thing I thought. This is a means of distributing the vested interest, capitalizing, um, and and doing it in a strategic way. For instance, the debt positions have increased interest rates associated with all the uncertainty in the market, and those deposit receipt tokens carry that interest. So you're pairing them with CRV USD liabilities or another, like, I mean, Balance of Federation could have these types of LP positions if their AMM code implementations support them. These derivative type of LP positions where you have deposit tokens paired with a stable coin. And these create additional liquidity flows, pathways for liquidity flow that carry relatively high interest rates because of the debt interest rate. So I find that potentially quite interesting. We could see the opening of increased liquidity pathways, which will have incentive systems applied, and liquidity depth will grow. And that's quite interesting. Maybe this that was a third tick on something that was intentional to have the relatively high interest rates to create these derivative LP positions to introduce these alternative liquidity flow pathways. I don't know. There's no way to know, but that is a speculation. Can it be the ultimate 4D chess where all these were intentional maneuvers? Um, I think, at minimum, I think it was thought to be manageable, overwhelmingly manageable under almost all circumstances. I mean, look how quickly the OTCs came in. They're like, all right, I'm going to buy it, I'm going to lock it. It's not like they're dumping on the market. It's certainly not at 40 cents. That doesn't make any sense. And who the hell's going to sell? What kind of billionaire or 109 figgy is going to sell for 100% gains? Nobody's going to, especially a protocol where all these people have shown up to acquire some vested interest. It's systemic. Protocol is systemic to the entire space. And they own a piece of that systemic infrastructure in moderate size. A couple $1 million position is nothing to sneeze at. I think protocols and OTC buyers were jumping at the opportunity to acquire these positions at that relatively reduced rate, the OTC price. Um, and that strengthened the overall picture of things in the market. At some point, shorts get squeezed. If you pay it three figures plus, 100, 200% to short these positions on whatever exchange has been chosen, Binance likely, at some point that's going to squeeze, and you know. So then it's everything stabilizes. Then this entire story just fades into, oh, that was pretty volatile. And in hindsight, if everything plays out like that, you're like, all right, I probably didn't have to react as much as I did. So that's pretty much my sentiment all week. Don't really need to do anything. I can't do anything except sit back and watch and contemplate, have thought experiments about what I would do. So what would I do if I was smarter than me and I had access to much more resources? And I'd probably think of some very crafty shit to do. And that's just me. And we're talking about people that are smarter than me, that have more connections, and they're international in different jurisdictions with different regulatory situations. I'd probably be doing some crazy 4D chess shit. I mean, hell, I'm me, and I do some relatively 4D chess shit with regard to like, not necessarily portfolio construction, composition, but certainly capital management, tax structure, diversification, so on and so forth. I do a variety of things that most people don't do, and that's just me. So I can only speculate that some interesting stuff is probably going on. Um, that was a little bit more than 60 seconds. My man. Austin, shout out to my dad. He watches these streams too. Hey, pops. little old Captain Rational. Me? All right. I hope I help folks. I mean, it's hard to see calmly the most volatile market that anyone could think of. But this is the market that I see the most opportunity in the planet because it's not a U.S. market. This is an international market. You know the deal. Big Captain Rational family. George. Hey, George. It's been a bit. How are you? Hello, everyone. Haven't joined in a bit. Yes, indeed. We're here. We're doing what we do. We're navigating. You don't abandon ship. You navigate. Chris, Jeremy, curve till we die. Well, the whole logic is it's you purchase something. And that's my sentiment. And I hang my hat on that methodology. A purchase has an implication. Obviously stores have return policies, so the analogy doesn't go that far. But the point is, if it's a purchase, it's not a position. If you look at the portfolio, there's no number, there's no value of it in a portfolio. So what is the value of such a purchase? It's how much is paying in cash. And how much is that cash likely to continue to occur into the future? And what is the likelihood that those cash payments will increase in the future? And is that purchase an appropriate size relative to free cash? That's the consideration that I have. And that's why I don't fret much, because I chose to purchase and I know the amount of cash that it will produce. And that's the ultimate equation. And that's what a lot of folks, are kind of failing with, like the real estate market. It's everything in the world, every investment reduces to ROI. You could look at buying a pizza shop, buying a strip mall, buying a rental property, buying a share of the S&P for 25 basis points. What is the ROI? What is the APR? How long does it take to get your money back, which is percent return per year? If you get it 5%, 7% on a real estate investment property, no, not me. If you get 0.25% on some equity, no, not me. Okay, now we're talking 20 to 40% returns in an asymmetrically volatile market. Now you're talking. That's an international market outside of the United States. Okay, now you're really talking. The crypto markets just tick every one of my boxes for what I want exposure to in a world where U.S. fiscal policy is a shit show. You got BRICS doing what they're doing, which is, just at the margins. That's some at the margin stuff. Stuff like that takes a decade or two to start to gain traction, so that's not on my mind. But on my mind in the short term is probably 2025, between now and 2025. And this is the exact market I want to be exposed to between now and 2025. And obviously, likely in 2025, I'll recalibrate this thought I'm having at the moment and say I just want continued exposure to this market. But now that's the time frame that I'm interested in. Like between now and 2025, I expect generally the system to have some sort of crisis, a credit event. Credit's basically frozen at the corporate level. There's no more balance sheet capacity for corporate credit with the Fed funds rate at these levels. The government crowds out debt for corporations. If a corporation is providing you 5 5.25%. And the federal government, whatever the hell it is, 5.25%, 5.5%, whatever Fed funds is, I don't even keep track, is paying 5.25%. What's the relative risk profile? You're going to have an increased risk profile exposing to the corporate 5.25% versus risk-free. The government pays face value of the bond with cash that it will have upon bond maturity, especially if it's a year. You're going to get your money in a year. It's a government bond. So you're going to take that money, or rather you're going to give that money to the government versus the corporation for 5.25%. So that's the whole point. With Fed funds rate at these levels, nobody's going to be lending to corporations. The government crowds out that debt market. So credit's frozen solid. How do we not inevitably have the swath of, mid-cap bankruptcies and obviously small cap and mom and pop that can't get net 30, net 90 from banks to finance OPEX? Oh my God. Where's the balance sheet capacity with banks with their balance sheet impaired like they are, with the HTM component of bank portfolios being drawn down like this? I mean, did you see 10 years today? Not on the 6-month. Where's the daily? Look at this daily. Look at the daily wick. Daily wick up to 5.125%, as I mentioned in a tweet earlier. And it's looking like it's putting up a ceiling from July. Oh, look at that. Look at this. Look at that. March, the entire year. This is a giant ascending triangle. I would say it's an ascending triangle rather than, like a pennant or a triangular compression from both ends. There's just too much of a horizontal ceiling right here. Horizontal line. I mean, look at that. 1, 2, 3 touch points. And that is just so suggestive to me that is a ceiling of a yield, 4.086%. You can easily see this shoot through with pressure. Because this was the ceiling, not these exacerbated numbers for 4.35, 325 to the upside. We're in a very difficult situation from the bond market, and let's take a look at that through a different lens. Bond volatility spiking a little bit, up to 115. These were numbers that historically are catastrophic. This region historically is catastrophic. 150 is catastrophic. Everything's frozen. Bond market's convulsing. Wick to the upside up to 200. That's crazy. So we're in the end game of credit being frozen, bond market volatility ready to wreak havoc, because bond volatility needs to be low in order for offshore dollar printing to occur to finance and lubricate financial activity worldwide. So with bond volatility elevated like this, it's creating frictions in the system, which decreases productivity, decreases capital availability, and basically just is a net negative, a net drag on the system. So note that, and time horizons, net drag on the system. The system is so large, it's like the super tanker type of story, that everything is a lag effect. It's so big that everything is a lag effect. So everything, if you're seeing a lack of currency production, you don't see the real effects for, 6 months, 12 months, 18 months. That's something they talk about often with regard to Fed funds rate policy. Lag effects. What is a forward-looking indicator or a lagging indicator? So I expect some shit to go down. That's the bottom line. Gazika, why do you consider ETH as a currency since it's used as gas? That's a good question. So it's not what you think. I've had bank issues where banks were denying me access to particular accounts because they are the custodian of capital, of those dollar liabilities. So I consider Ethereum Cash, particularly because I am the custodian. I have them in my custody. I could walk across a state line. I could walk across a border. I have them. So that is something I'm not dependent on the bank being a custodian of capital that I may need. So it is a non-custodial source of capital. You don't have that necessarily with stable coins and CRV USD, Frax. It's getting interesting, but I'm not at the point where it's like a non-custodial dollar liability. Uh, so relative to position sizing, I probably want less of those dollar liabilities and more of the non-custodial asset, even though it's not dollar stable, it's dollar volatile. So I'm willing to pay a premium for the complete, unquestionable non-custodial aspect of the cash unit in exchange for it having that property and not the associated 100% lendiness of the dollar liabilities that are starting to emerge in the crypto space. Pure algorithmic dollar liabilities that are not dependent on external components. And Frax v3 is very, very interesting stuff that Frax is putting forward, like not tying the price point to USDC. I mean, come on. USDC, when we had that stability issue, reared its ugly head. It's like, but if Frax could be a dollar without USDC, then that's heading in the direction of the way I view my comfort level with regard to ETH as cash that I could access at any given time, not dependent on Circle's counterparty risk exposure at the banking system level. They're exposed, and I don't want that, at least with the majority of the cash position. So this is how you position size the cash position of your portfolio. And the same way with Bitcoin. That's even more non-custodial to a degree than Ethereum, different network, different narrative, so on and so forth, but it's a form of cash. I don't consider Bitcoin, Ethereum, or Ethereum as investments. And I'm not the point of even considering like Alt L1s, Alt L2s, ARB, AVAX, Matic, and stuff like that as cash, albeit maybe they're like just much more volatile forms of cash. But obviously Ethereum and Bitcoin are at critical mass, the leaders of the pack at least, and that's how I define them as part of the portfolio. So I don't consider them investments. They are my cash position. If I need cash, I have cash. And that's and then the composition of the cash position I adjust according to risk tolerance and stuff like that. Hope that helps. Soon, good morning. James, hit those likes. 20 people in the stream, 7 likes. Hit that thumbs up button. George, haven't checked. Did you get any more curve on the dip cap? I haven't done much of any financial activity. I just been accumulating cash, obviously, adjusting that cash position composition as I just talked about, and that's about it. I get tempted, obviously, to allocate more. Nolo's behaving very interestingly, but I got it at such a cheaper price point, so that inhibits me usually deploying cash. Whether I want more Bitcoin, whether I want more Ethereum, or whether I want more stables, I don't know. I kind of like have a high opinion of what's been going on with CRV USD. It's been behaving extremely well from a data level, which I do follow in my relatively large set of Dune dashboard links. A lot of Dune data up here. Boom! I think I got 5 boards on CRV USD data. So it's been behaving extremely well. I look forward to what the hell Frax is cooking up. I think it's coming really soon, which is very interesting. So that may adjust my cash position composition in the midterm. I don't do anything in the short term. Have I thought about like more aura? I've looked over the numbers because the equation is you're purchasing revenue. I could buy $1,000 a week for how much money? And what is the likelihood for that $1,000 a week income to continue into the future? And what are the odds based on dinner table investing? You remember that one, of that $1,000 turning into $1,500 next year, $5,000 in 5 years. So those are nice thought experiments to have. So I haven't had enough drive to deploy more, considering stuff like looking over the payments, which is dollar per VL Aura, 3.4 cents, is not hitting my fancy right about now. And definitely not on CVX CRV. This is much more expensive. The price of convex is significantly more expensive than VL Aura. So VL Aura is much more productive. You get much more bang for the buck. I deploy X amount of dollars for $1,000 of revenue per week. Your purchase price is significantly cheaper with VLR as compared to VLCVX, and that's that. That's the bottom line there. Noah, sorry if you already covered, but do we have to worry of the curve loans? What does it really mean for Curve's future? I covered start of the stream to a degree. I think it's whatever it is, just like with politics and especially geopolitics, it's much more complicated than we know. The actors involved are very smart, and it would be awkward for it to not be much more complicated than we know. And I think that when you're in a setting of like a war room or an OTC conversation, parts of that complexity are conveyed. Not an investment, but it's a sale. What are you selling? What's the benefit? Everyone does a cost-benefit analysis before committing to a capital exchange, and the pace in which OTC occurred to the particular actors, no matter what anyone's sentiment is regarding the particular actors, that was quick. That was very quick. And there's a reason. It's systemic infrastructure, and Michael distributed power over that infrastructure. And that vested interest is now distributed. And I know with regard to like large scale capital investment, if I'm going to deploy 15, 20, 30% of my portfolio, I want to know who the vested interest is. I want to know if it's concentrated because I want to know what kind of risk I'm taking on from that actor who has the concentrated vested interest. And I don't like to see concentrated vested interest. It's a relatively great deal of risk if that actor wants to do something that, if Michael decided to exit and sell all his curve, the whole system is done. So everything I've seen is actually very supportive that intentions are growth and continuation and expansion and strengthening and deals and arrangements and expansion of the Federation, which is comforting, very comforting. And that's nice to see when this entire market is plagued with exit scam, exit. It's when you have large vested interest, someone that has 40% of the portfolio circulating supply, and exits. There goes the price. That's when you get the wick down, the scam wick down, 80% drop in value. It's vested interest exiting. So vested interest is everything in understanding the risk that you're taking on when you take a position. Who owns what, how much, and what their intentions are. So you look indirectly to assess intentions. You got to know psychology, like got to get into their heads. What are they doing? Why are they doing it? Are they sharks or are they the remora fish? That's why I post this image on social media. Are they the remora fish? The remora fish swim amongst the sharks. Now, clearly, no one watching me is a 10-figure, market actor with a couple $1 billion. So we're all remora fish. And optimally, you want to find whales and sharks that are like, hey, what's up, bud? Hey, you want to come along? I don't bite. So this analogy, this biological analogy is spot on. You want to find allies that have aligned vested interest in the success of something. Aligned vested interest changes the equation. This is few and far between because all of us I'm one of these little fish along with you guys. That's the deal. Hope that helps. Hey, Cap, what is the money market push? The interest rate is curves that he will have to repay it or get liquidated. Will be lucrative. There's a whole lot of stuff that could play out. Market dynamics. Let's take a look at the chart. I mean, this thing is rock solid at 57 cents. We'll see what happens. The chart tells the story. Um, Finance indicator, open interest. I think that one works well. No, it's not loading. No, that should load. Come on. So there's a lot of leverage. The leverage longs. Open interest? No. I was looking at one earlier that was working very nicely. Mm, okay. Anyway, point being, there's a lot of leverage shorts going on right now. And if the shorts can't drive down the price and they're underwater, paying 100, 200% per year to finance their leveraged short, eventually they exit. And when shorts exit, this thing's going to go to like, it could easily breach this stuff. If there's $150 million worth of short interest, um, paying 100, 200% a year, you're talking a push to like, oh, if it pushes over $1, that's very interesting from a daily moving average perspective. It's a breach to the upside. Clearly, you see a big wick, big capitalization from the open longs closing their positions. So anytime you have a short liquidation, you have longs exiting, taking significant profits. So a nice wick to the upside certainly is indicative of directionality reversal, or at least conditions that express a likelihood of directionality reversal to the upside. So structurally, we had a big wick to the downside. Technicals are not too distorted from this price action. This still has an expression of an inverted head and shoulders. Um, and that's comforting to a degree. It's not like even amongst all this insanity, we had a strong invalidation of a decent inverted head and shoulders structure. And you really need to see us get over the TWAP on the monthly. We haven't been over the TWAP on the monthly since February of 2022. It's a year and a half. And you don't even have data back to when it was a breach. Maybe it was a breach of the TWAP on the monthly back in July of 2021. 2021, talking 2 years ago. Got to expand the time horizon to see where the hell we are. So we've been below the TWAP this entire time. We weren't. There's never been a structurally bullish. Hasn't been a structurally bullish condition for a long time from a decent time horizon. The monthly. You got to get to $1. You get to $1. Can you imagine if open interest short liquidation pushes this thing to $1? That's the first time we even touched the TWAP in a long time since it broke down in April of 2022. We haven't touched the monthly TWAP. We haven't even touched it. Tried to touch it in last month in July of 2023, but we didn't. So got to crush some shorts to actually see that happen, it looks like. Um, George, how do you find the revenue from the pizza shop business evolved lately? I know you mentioned it went down at some point. Is the drop significant? Sure. 2021. Oh, that was just a naughty number. And I'm I guess I'm relatively humble, but I consider that number just to be extraordinary. And it wasn't like I was making millions of dollars a year in cash flow, but the number was like, yep, thank you. That amount of cash was crazy. So the numbers are probably all of 22 to last month. I don't know if this month will dip. It's real time, but all of 22 to now is probably about a 75% reduction in cash flow. And when I could say for myself, that was like cool. Because that's how relatively high the number was in 2021. That a 75% reduction in cash flow has been quite comfortable, navigating in Like, all right, cool. It's still a fair amount of capital. So cash flow has been very nice. I've been very comfortable over the last year and a half through dark days of 2022 and FTX liquidation and Luna, and even now with all this shit going on, I'll know more this week. Uh, I look over the Warden, Stake Dow, Aura, Hidden Hand, stuff like that. You look at the Llama Air Force for how much dollar per VL Aura is cranking out, and you know, hopefully that number stays up, and I think it will. I think the financing is going to continue. I have a high expectation or a high inclination to think of a relatively unabated flow of vote rental financing. Trevor, a pleasure. Putemkin, any thoughts on synthetics? Yeah, generally, high opinion of Kane, high opinion of the protocol, survivability characteristics written all over it. Questionable amongst there's many detractors. Hasn't proven, just the most wonderful investment. And for me, I reduce everything to potential liquidity, so optimism. That's the thing that just invalidates it for me as a portfolio component. It's just optimism is microscopic. And that is what it is. I use rules, and that's one of my rules. I follow the money. And the money's not on optimism. Now, there's plenty of interesting things going on over there. Obviously, GMX is on Arbitrum, and stuff like Quenta has shown interesting functionality, being a synthetics component of sorts. But Pika over at Optimism, a lot of folks interested in that. So there's great potential for these proto federations, as I call them. But it's just not enough to garner much of my attention. I find it quite interesting that YOLO came over from Solana to mainnet, but is still operating on the liquidity from Solana, which is quite interesting. So that's cool. I've been PepperDex I was interested in, but I was able to restrain myself. The amount of cash that I have earmarked. I needed four things. I'm expecting volatility. I'm expecting risk off potentially. So I can't justify capital deployments right now. I have home modifications and some bills that I expect to pay next year, and I just can't justify additional expenses right now, especially stuff on all chains. So I invalidate synthetics quickly. I invalidate stuff on Arbitrum quickly. I invalidate almost everything on Polygon and AVAX, and it was really mainnet. That's it. And I can't. That's the network where opportunity exists. Why? Because that's where the vast majority of currency units are. Your game here is to get a piece of the pie, a piece of the currency units. So when there's more currency units, that's where the potential is. Just remember that this game is scored in dollars. And for instance, if the cash position, and you're thinking of my Ethereum and Bitcoin exposure in the cash position, I'm paying a premium for the non-custodial component of the cash position. So that to me is worth the expense. You don't know what it's like until a bank freezes an account and you don't have access to it. For 2 years, I had to wait 2 years going to a silly judge, and then it took a month and a half for the bank to respond to a court order just to give me access to a bank account. So when I experienced that, I'm like, yeah, I don't trust these motherfuckers. Oop, excuse me, especially for folks that listen to me in the car. I'm sorry if any little one's ears heard that. I appreciate all of you. Thank you for joining. Stay with the markets. Watch your risk. Watch your portfolio composition. Watch your cash position, and expect it doesn't make any sense that some shit isn't going to go down. It doesn't make any sense that we're not going to have a volatility event of some kind. So expect the volatility event, and maybe you want some cash to pick up something on the cheap if you have that kind of stomach. I personally didn't buy any curve down at 46 cents. I don't stomach the volatility anymore. I don't have any time and patience for it. Taking a position is the hardest thing anyone ever does in the market. But have that expectation in mind, the volatility event, and Look at the debt to GDP of the U.S., the composition. They're going to have to do QE. They're going to have to buy and drop the rates, and the liquidity cycle will flow in this market's favor at some point. It's inevitable. It's cyclical. Every 3 to 5 years, you get a liquidity cycle. And when that liquidity cycle happens, your assets go asymmetric. You've just seen it time and time again. Whether it's a year from now, 6 months from now, 2 years from now, you don't give a shit because it just goes asymmetric. So appreciate all of you. Last one, Velo. Dave asked about Velo. I'll keep it simple. I like, I forget his name, but I like Velo. Optimism. Just can't do it because of optimism. And I'm not fond of the top vote renters. Um, I agree with him on the OP incentives that they'll probably be sustainable to a degree. But I'm not fond of the top vote renters. I'm not fond of the composition of enterprise that are renting votes. I'm not fond of the enterprise that is established on optimism. What is enterprise? What are these businesses? What are you buying? What are you investing in? Is it an FX exchange? Is it a credit market? Is it an offshore liabilities printer? Eurodollars, which is a form of credit. Dollar liabilities. That's why understanding traditional financials is so imperative to understand what you're actually buying. It's not just token and price and go up and down. It's what kind of system is it? Is it significant? Is it systemic? Is it building a federation? Become entrenched and achieve lendiness. We'll see you guys on Friday. Thank you all for your time. Peace.